What's up, everybody? Jake Blickenstaff here with the Northeast Georgia Real Estate Podcast, coming at you with another video here with my buddy Evan Nissley. Appreciate you. Good to see you again. He's with PrimeLending here in Bethlehem, Georgia. So I always like getting a chance to get together with Evan because, for one, he's in the mortgage space, so he has a really good pulse on what's going on in the market. And so that's kind of what we're going to be talking, or actually 100% of what we're going to be talking about today, from not only his perspective, but also from my perspective as an agent and a broker, and just really kind of trying to paint this picture. And, stay tuned to the end of this because we're going to talk about really kind of what our perception of the crystal ball looks like with what we think might happen. And really that's kind of at the end of the day what everybody's trying to guess and pinpoint and, time the market. But without me blabbing on too much, Evan, since the last time we spoke, what's been going on with you? How's business going? Tell me, give me the whole rundown.
Yeah, so I guess the last time we met would have been sometime last year, around probably this time. Mm-hmm. And man, if you told me last year when we met, we were doing this, that, the next 12 months were going to be even more difficult than the previous 6 to 8, I'd have been, I don't know, I may have hung it up then, but that's been the case. It's been a challenging year in the mortgage world. We've seen rates, do things that we didn't expect. Last year we were expecting that we would see the Fed raise rates and quickly, stop and pivot and cut, and I think the talk around this time last year was that, first quarter of 2023, we'd start to see rates drop. And we did. We saw rates come down early January into February, back into the high 5 range, and it was gangbusters. I mean, it was a kind of a good test of what the market would hold as far as mortgage rates and activity, and things went crazy for a couple months, and then rates started to move back up, and it's been a little bit of a volatile summer, but as of right now, rates are back up into the low 7s, so pretty high considering.
And so to paint the picture a little bit better, not only for anybody that is watching this like now or recently, but like if anybody comes across this video like down the road, just so you have a clear understanding of like what the market dynamics are right now. Like today is August 24th, Thursday of 2023. And I know that like tomorrow, one of the big announcements that's going to happen from the Fed is
So they're doing the Jackson Hole Symposium. So it's a meeting between the Fed, the policymakers, central banks, and they are basically, looking at, the theme this year is the structural shift of the global economy. Mm-hmm. So, tomorrow there's going to be a speech by Powell, and, it's so crazy how the markets hold on to his every word, what he says and what he doesn't say. And, we feel like the theme is going to be, the higher for longer, that basically that, there's still a fight to be had to get inflation under control. There's still more work to be done. And if you ever come across the term hawkish versus dovish, so right now we're in a hawkish, monetary policy phase, and that's where, money tightening, so tightening money supply, and then dovish is the opposite. So the people I follow, and, no one can predict this stuff, but that it will be a mildly hawkish speech that basically is, hey, we still have a little bit more to fight, but we do recognize that there has been some improvements, and that what they are doing is working.
Yeah, and I know that from all of the like Fed meeting minutes that I've watched, Powell kind of talks about out of both sides of his mouth.
Sure.
So he's like, hey, the numbers look really strong. However, there's a lot more pain that's going to need to be felt.
Right.
And so everybody's like, wait, is it good? Bad? Wait, what's going on? Like, how do we react to this?
Right.
And so nobody really understands or has a full grasp because, and I've said this before, I think I might even said it on the last video, but I mean, it's a common theme that I stick with where the Fed is like that drunk guy at the college party. He's the last one to show up and he's the last one to leave. So the Fed is the last one to the party. So they were 6 months late to starting to raise interest rates, and they're going to be 6 months late to where they stop the pain. So just realize that whenever they're going to be involved in the process, because rates basically sat artificially low for an extended period of time when they didn't need to. And by no means, I'm not the mortgage professional. I just,
we're just two guys talking.
Absolutely.
Nobody knows what's going to happen. If we did, we wouldn't be doing this video, but we love these videos.
Absolutely. And so, like with all that being said, from the real estate actual side of the perspective, to know what's going on in the market for the month of July, I just put this out in my newsletter. This is coming from the Athens MLS, and it includes information for Clark County, Oconee County, Oglethorpe County, Madison County, Jackson County, and Barrow. There may or may not be some data that's missing from Barrow just because the Athens MLS, we sit on an island, but that's kind of irrelevant. So anyways, there were 461 active listings at the time that I pulled this list earlier this month, and this is for the data for the month of July of 2023. There was 192 new listings, 196 total properties that sold. The median list price was $399,450. The average sold price was $415,712. List sold price average still banging right at 100% somehow. The average days on market's 39, so that's starting to trend up. And the expired listings was 217. And so my perception of this when I had originally put this out was we're seeing a large number of homes that are expiring due to people that are still holding on to pricing from last year and the year before. They're like, hey, I want this certain dollar amount for my house. I'm not going to do it less. Because they don't have to sell. But it's one of those, if you make me a move, I'll consider it pricing. And then you really need to make sure that you have an experienced realtor or broker working on the transaction, because this isn't where you can just throw a price at a property and hope that it sticks and get 26 over list price offers like we saw back during the heyday. If a property has the trifecta, and this is on the residential side where it's like great location, move-in ready, and great price, I mean, you're going to get multiple people looking at it, and you're probably going to get multiple offers. But if you're not trying to beat the market in whatever direction that it's heading, you're going to be sitting, and you're going to have to deal with price reductions, and you're going to have to deal with longer days on market. And the more that you do that, the more that you have the ability to stigmatize your property, where it's like, and I'm sure you guys have done it, I know I've done it, where you look on Zillow and you're like, if I know that everything is selling right now in like a week, 2 weeks, maybe a month, why has this property been on the market for 2 months?
Right.
There's something wrong with it. Right. I'm not even going to waste my time and go look at it.
Right.
So if that's the case, don't even bother, because if you're not going to go look at it, other people are going to do the same thing, and you don't want to put yourself in that situation.
Right. Yeah. Absolutely. It's you hear the term move-in ready, right? Mm-hmm. So that's even so much more important now than it was in the past. Where if you are going to price your house, if you're pricing your home to sell, or if you're pricing your home to sit, either way, like if you're wanting to sell it, like properties just have to be at a higher standard these days.
Yeah.
Buyers want move-in ready stuff. I mean, when they're having to contend with 7.5% mortgage rates, if they are taking out a mortgage, then that's a strain on the pocketbook. So, we in our world, we're always optimistic that we're going to see positive change. I do think that's going to happen. I feel like, based on what we see in the media and this whole conversation around a, soft landing, there's other factors in there that, may not be being portrayed. And honestly, when recessions do hit, they generally hit with little to no warning. But they talk about housing, and housing is typically a first in, first out, meaning that when we go into a recession, housing normally is what's affected first, and it's normally what recovers first. Now, if you look at this year and you look at the appreciation rate for housing, we're on pace to see anywhere between a 5 to 8% appreciation rate. If you look at the folks that follow this stuff, BlackRock, Zillow, CoreLogic, which is better than historical average, right? Yeah. So we're in a time when unaffordability is high and interest rates are high. So to me, this year is a true litmus test to the market as far as values are concerned. So, for the folks out there who can buy, and that's the first question is, can you buy? Can you afford? Does your budget fit the payment that you're going to take on with a mortgage? And if the answer is yes, well, that's the answer to me, right? That's my opinion, because you can't time this market. Mm-hmm. If you look back over the course of time, real estate is a very solid investment, and there's other ways you can look at your return on investment, right? You look at the leverage piece with the mortgage part. That's something we can dive into further later on. But overall, if it is the right time to buy based on your budget, my advice is dive right in, and because honestly, what happens? So you buy a house at a 7.25 rate today, you refinance it later. If the rates go down, if rates go up, you've got a better rate than the market. But it's all based on everyone's individual situation and what they can do.
Yeah, the tough pill to swallow right now for the majority of the customers and clients that I work with and I interface with on a daily basis, I'm sure you're seeing the exact same thing, is for one, if people don't have to move, they're not going to. Secondly, people are so locked in or tied in to the mortgage rate that they have for their current property. I got it at 2.5% or a 3%. I don't want to get rid of that. But the elephant in the room that not a lot of people are talking about is the overwhelming credit card debt that is like sweeping the nation.
Right.
And like I work with a bunch of lenders that talk about, hey, we're doing refis right now or home equity lines of credit to be able to pay off some of this credit card debt.
Yep.
And I mean, somewhere, somehow, it's got to give because there's a ceiling on that, right?
Absolutely. Yeah. Credit card debt has a limit, and that's the reality of it. And right now, credit card debt's running between 19 to 22%. So, getting eaten up in interest, and so folks hang on to a low mortgage rate while they're struggling to make ends meet, and sitting on hundreds of thousands of dollars of equity in their home, it's tough to give that up. And maybe the home equity line route is a better route than doing a full-on cash out refinance and just doing a whole new mortgage to pay everything off. Either way, though, there's tools, there's people, there's so many things that are out there, information-wise, to know what you're getting into and to be able to plan accordingly. And there's professionals out there like myself and you that can help guide our clients through that process. I would encourage anyone that's watching this that maybe just in that situation, act before you can't. And what I mean by that is generally when you need credit, it's hard to get. Mm-hmm. And we're going through that cycle now where mortgage companies are faced with warehouse lines getting cut. Margins on mortgages are low. So there's not, there's a lot that goes on behind the scenes, but the whole credit crunch, if you've heard about a credit crunch across the U.S., that is a real thing, right? And the Fed wants that. They want credit to be tightened because that's going to slow things down. That's the thing. So
remember that their whole, from the Fed perspective, their whole purpose in life is to try to get to that 2% inflation target, which is not where we currently are. I think the last numbers I saw was it a 4.5 or a 5 or somewhere?
No, I think in the 4s. Yeah.
Okay. And then I saw another article that was kind of humorous. I don't know the realistics of it, but it was talking about, well, if you take out like housing, if you take out like gas, and you take out like food, then we're really close to like a 2.5%. It's like, well, that's the majority of the things that the Fed's looking at that affects absolutely everybody. So why would you remove those statistics out of the numbers that you're analyzing? I don't understand that part of it.
Well, brother, you just spoke into something that's even like, it goes back to us being able to predict things, right? Like anyone can spend anything in any way, right? So you can take data and you can spend it one way, you can spend it another. You just told me a minute ago, we watched a video. Mortgage applications are down 30% year over year. On the face of that, it's like, wow, that's a big deal. But that still means that there's 70% are buying or are taking out mortgages even at these rates. So there's ways to look at data, and you can spin it in the own narrative that you want. So we don't know what's going to happen. We do know that, again, historically speaking, real estate, fantastic investment. This year has been a good test to the market, and it goes back to why is that? Inventory.
Yeah. And with regards to inventory, like one of the bits of advice that I'm giving people is that, like, if you need or want to buy right now, but you're on the fence because you're like, I don't want to pay or don't want to give up the current interest rate that I have, or I don't want to get a higher interest rate just to be paying down to potentially refinance later, you need to look at it from the perspective of, if you were to buy a house now and it checks the boxes as far as like it's a need because your family needs it, like you're either growing, you got a divorce, God forbid, or whatever else, it was a need for you to buy that house. If that's the case and you can afford the payment, then go ahead and do that as long as you don't have to sell within the next like year, 2 years, 3 years. Because, like what Evan said, buying real estate's like anybody that bought real estate or bought a home or bought anything real estate related in the last 30 years hasn't regretted it, or at least never that I've heard of. So if that's the case and you're going to buy it now with the intention of holding on to it for a while, who cares what you're paying now as long as you can afford it? Because more than likely rates are going to come back down. And like Evan said, if they go back up, then you got it at a great time. But you need to realize that if you're on the fence currently, what do you think is going to happen if we have a limited number of inventory and rates come back down, and now everybody that was on the fence, the the thing that was preventing them from being on the fence has now been removed. And so now you're going to have an influx of people coming back into the market that are all trying to buy. And you're going to see a massive surge on purchases, over list asking price or over list offering prices on these homes. So I mean, it's going to flood the market with some additional buyers. And from all of this, the data that I've seen ever since 2008, we have never effectively caught up with population growth based off demand for housing. And so if we were to actually do that successfully, it would probably take another 3 to 5 years for us to do that.
And a lot of new homes.
That's a lot of new homes. That's a lot of new building. And we currently, there's not enough homes to justify or to keep up with population demand. Right. I mean, and if without putting on our tinfoil hats and going super far one way or the other, I mean, I think by like 2030, the World Economic Forum said that nobody's going to own anything. Essentially, it's going to come down to basically your rent and everything. It's either going to be overpriced or whatever. So, I mean, you guys can do your own research on that. Like I said, I'm not going to get too deep into it. But with everything going up in price and everybody getting pushed into potentially a rental market, you know, just makes you think, go ahead and solidify your place right now with your own assets.
Yeah, I mean, you know, you got that's a valid point. More so is that, you know, you've got another competitor in the buyer's market these days. Mm-hmm. It's the investor.
Yep.
You know, and that's a huge competitor. That's a lot. That's deep pockets. You know, that's cash offers, and I don't see that going away. And you know, why would it, right? So if the powers that be have decided that real estate is a good investment, residential real estate, you know, it's only a matter of time, right? Mm-hmm. So one of the things we're doing to help try to combat this market in a sense is my team and I got together a little over a month ago, I think, and we decided that we wanted to offer up a free 1% rate reduction for the first year.
Right on.
It's not, there's no smoke and mirrors behind this. It's nothing that we're building into the rate or into the fees. We're actually taking a comp reduction in order to offer this to our clients. We feel like, you know, a lot of nothing is not as good as a little of something.
Right.
And, you know, so that you know, get into more specifics if you'd like, but, you know, just throwing numbers out there on a $450,000 loan amount, the monthly payment is going to be about $300 to $350 a month less for the first year. With that, it's called a 1.0 buy down. It works for conventional financing, FHA, USDA, and VA. Really, the only things that it doesn't work for is your jumbo loans, which is anything over 726.2 typically, or some of your other creative programs like your DSCRs or your bank statement stuff.
Okay. Well, very cool. I mean, I think that's a huge opportunity. So if you guys see this and, you know, that has piqued your interest at all, I would highly recommend reaching out to Evan. Somewhere around this video is going to be his contact information for you guys to be able to get in touch with him. But with this being primarily like an economic forecast kind of podcast video for today, not only have we talked about like what the current situation of the market is, but let's kind of get into the crystal ball portion of this. And, you know, where do you think the market's headed? What do you think's coming next? You know, what do you think's maybe something that we need to be paying attention to or anything like that?
Well, you know, I do think we are in a more challenged environment from the economy standpoint than what, you know, is being portrayed. Mm-hmm. I really do. You know, we talk about credit card debt. You know, we had student loan payments starting back up. God, I'm losing my train of thought here. Take it for me, buddy.
Credit card debt.
Yeah, credit card debt, student loan stuff.
Student loans. I don't remember what the other point was that we previously went over.
Right. Oh, the inverted yield curve. Wow.
Yeah.
So that's, you know, there's things. So right now, short-term bonds are paying higher than long-term bonds. So investors are buying short-term bonds over long-term bonds, which is hurting mortgage pricing. So that's why, you know, when mortgage rates are set by mortgage-backed securities, the trading of those. And when more people are buying mortgage-backed securities, that's causing rates to go down, and vice versa. So go back to the pandemic, the reason rates got so low is because the Fed was the buyer. They were dumping money into the bond market, pulling rates down artificially. So that, you know, somebody's going to pay the piper on that at some point in time. And, you know, it just, if you go back to recessions, they aren't typically forecasted. So if you talk to folks that follow this daily, outside of me and you, because we have, you know, not only do we have, you know, to know this kind of stuff, we have to work with clients and we have to be able to do our things. The prediction is that early next year, there will be not necessarily a pivot, but, you know, when the Fed decides to finally put the brakes on the hikes, when they come out and say, hey, we're good for now, you're going to see mortgage rates get better just off of that. So the 10-year Treasury yield is sitting at 4.3 as of yesterday. Mortgage rates are around 7.25. Generally speaking, mortgage rates track the 10-year Treasury at about a 1.75% difference. If you look at that over time, meaning that mortgage rates are usually around 1.75% higher than the 10-year Treasury yield. So if that were the case, rates would be somewhere in the low sixes right now. And I feel like that's just that act alone from the Fed, that guidance, that direction will get us into a better place with rates, which goes back to what you said a minute ago about how lower rates, more buyers, more opportunity. Market's probably going to take back off again. We've already seen it happen.
Yeah.
It's not like we're just blowing smoke here, guys. I mean, obviously we're biased, right? We're in the market, we're in real estate, we get paid to close transactions and do loans. That's not what we're saying here. It's that take the data, take the information, and that's all we can do to make the forecast.
Yeah.
So I do think we're going to see rates in the sixes probably by early next year. Where it goes from there, nobody really knows.
Yeah, and I've seen a bunch of different data talking about where when rates do come back down, even just a little bit, exactly like what Evan was talking about, even back down to the sixes, God forbid, hey, down to the fives would be fantastic. You're going to have more buyers in the market. We don't have the inventory to support the population or the current demand. So prices are going to go up, but that could potentially set us up after we get through this non-recession recession that we're in, where we have potentially all the rest of 2020s to be another bull market for real estate.
Right.
And then at that point, what does that look like on the backside of that?
Right.
So a lot of it is 100% hinged on what the current inventory is and the demand. And if you go back and look at what population growth is year over year, I mean, those people have to live somewhere. I mean, just plain and simple. And so it's either people that are conceding, saying, hey, you know what, I don't need this big house. I'm going to buy something smaller just to be able to be in something. That happens. You got families that are starting to mix up multifamilies into single households. So, I mean, that's an option as well. And, I mean, you still have the luxury property market as well. So, I mean, there's a lot of different kind of ins and outs and facets to all of this. But it'll be interesting times for sure.
Yeah, the inventory problem, it didn't just start last year. It started the year before that. This started back in 2008, 2009. So, the housing crisis, it caused builders to shift how they do things. And, it's fool me once, shame on you, fool me twice, shame on me. Like, they aren't building houses at the same levels that they have in the past. Didn't really seem like that big of a deal up until, COVID, when you had the perfect storm of crazy low interest rates, millennial home buyers really entering the market, and that's when it was exposed. The work from home stuff absolutely had something to do with it too.
Yep.
So, we're just, who knows if supply will ever catch up with demand in housing. It won't happen anytime soon. And unless there is that black swan event that causes, mass unemployment, I just don't see it. I don't see any way that the housing market is going to significantly correct anything over like 10 to 15%. I mean, you're going to see some seasonal adjustments, and you may see some markets that, are still a little overheated that are going to, pull back some. But reality is the economy is flush with cash, and there's a lot of cash buyers. So it's not just the mortgage rates. It's not all that plays into this kind of stuff.
Unfortunately, like we were talking about, the Fed still needs to see some pain happen in the marketplace before they calm down. And they really don't care on how bad that gets. They just are paying attention to the lagging data to be able to justify whether they're going to raise rates, keep them steady, or decrease them. So I think we're definitely still going to be in some hurt for that. But it was fantastic. I love getting together and talking about this stuff and seeing, like, I'd love to do these, or we're going to do these at least 2 times a year.
Yep.
So like in January, talking about, the last July update, kind of mid-year, beginning of the year, and talking about, where do we see this year going, and kind of recap where everything's been. And I'm going to be doing the same stuff on the commercial side as well, so stay tuned for that. Just really diving into what's going on, commercial dynamics, and lending-wise on that side of the fence. But as always, brother, it was a great opportunity to sit down with you. Any closing thoughts?
I think we've covered a lot.
Awesome. Well, if you guys want to take advantage of that 1.0 buy down, definitely reach out to Evan Nissley and his team over here at PrimeLending. Like I said, his contact information is going to be somewhere around this video. You can call him, text him, email him, send smoke signal, stop by his office, bring milk and cookies, the whole 9 yards. But appreciate you guys. Definitely stay tuned to the next episode of the Northeast Georgia Real Estate Podcast. See you all in the next one.
next episode.
Hey, so as we wrap up another episode of the Northeast Georgia Real Estate Podcast, I want to extend a big thank you to our remarkable guest, Evan Nissley. Your insights are always a wealth of knowledge, and I'm truly grateful for your time and participation. Now, to all you property owners out there, whether you're considering buying, selling, or leasing commercial or residential real estate in the greater Atlanta, Northeast Georgia area, or even western upstate portion of South Carolina, remember that we are here to support you. Our dedicated team is ready to guide you through every step of your real estate journey, so please make sure to reach out. Now, our team is a powerhouse featuring specialized commercial agents who excel in leasing and sales across diverse categories such as office, retail space, industrial properties, multifamily residences. Now, on the residential side, our agents specialize in everything from traditional single-family homes to luxury estates, and even navigating the intricacies of the REO and short sale world. Now, here's something exciting for all of you licensed agents out there across the Southeast. Covering South Carolina, Georgia, and Florida, if you're currently seeking a new supportive community of real estate professionals who can act as your mentors, advisors, coaches, friends, please look no further. Here at VPR First Team, we provide exclusive one-on-one access to some of the most successful commercial and residential realtors and brokers in this field. So if you're looking to learn, grow, and thrive in your real estate career, or if you're on the hunt for a new home, don't hesitate to reach out to us. We're here to make that journey as smooth as possible. So thank you again for joining me on another episode of the Northeast Georgia Real Estate Podcast. If you've enjoyed the insights shared today, remember to subscribe, rate, give me a thumbs up, and make sure to leave us a review. But until next time, keep those dreams alive, and we'll catch you on the next episode.